Welcome to this program on M&A organized by the Young Members Empowerment Committee of the Institute of Chartered Accountants of India. This is a program that has been designed for our younger CA colleagues to understand, and based on the experience that will be shared by my distinguished colleagues, CA colleagues, CA Sujal Shah and CA Drushti Mehta, along with myself, CA Amrish Shah, on this program. So, what is it that M&A is all about? I think we are going to cover that. We're going to cover what are the valuation parameters that one needs to look at, and obviously, as all CAs would like to look at it, also on the tax and the regulatory aspects of some of those, M&A deals or some of those M&A options. Why M&A? M&A has always been, described as mergers and acquisitions. Is it always true? Not necessarily, because the other word for M&A is also mergers and alimonies. And why so or distinct terms for the two? Clearly, because if it is successful, it is a marriage. If it doesn't happen to be successful, may result into an alimony situation. And therefore, one needs to be careful when one is looking at M&A, because it's not only what one does, but there is a lot of things to be done post the M&A deal is clicked, and obviously during the M&A deal being done, and that's very important. But do M&As happen? Yes, M&As does happen all the time. And if you look at what has happened in the first 6 months of this fiscal year, I think the number of deals that India has seen has not only increased quite a bit, even the value of those deals have increased. So if I just look at a quick comparison between FY14, we had roughly 674 deals, roughly around $22.6 billion worth of deals. But if I look at the first 6 months, the number of deals is 416, and already we have covered 16.2 billion worth of deals. So it's improving drastically, and therefore this is the right time to look at what happens in an M&A deal as Indian economy is improving, India sentiments are improving globally as well as within India. I think this is just the perfect time to look at what happens in an M&A. What happens actually in an M&A? If I were to look at it, I think there are strategic imperatives, and as confidence and business confidence improves, I think people will want to look at growth. They want to be in a better competitive position vis-a-vis in their own field and vis-a-vis their competes, and obviously want to be market leaders. And if they want to grow, then they will get the benefit of economies of scale and scope in total. So if I look at what happened between ING, Vaishya and Kotak Mahindra Bank, that's a growth story to look at, because you are acquiring another bank, you will therefore get a ready setup done, and that will help you. Or I look at Tech Mahindra's acquisition, which got announced on Lightbridge Communication. It gives them a leap, and it improves their overall turnover, looks and pushes them towards the vision even closer of achieving a certain turnover in a certain period of time. So that's the growth part of it. It allows you to. But there could also be capability acquisitions. So if you look at either acquiring a new technology or a competence capability building. So again, if I look at Tech Mahindra's acquisition of Mahindra Satyam a few years back, they moved from what was the telecommunication sector as their core capability to even adding some other sectors like financial services as part of their strategy to rely on more sectors rather than any one sector in particular. So that's the way people would want to grow. There could also be a diversification that one may be looking at when we are looking at M&A. So when I look at Vedanta's acquisition of Kane India, they moved into the oil sector or the oil exploration sector in addition to the metals and mining sector that they were already into. Or it could be to exit non-core businesses. So if I look at the Mahindra Group exiting the Systech business in forming a sort of a joint venture with CIE, it is sort of an exit. Or there are global acquisitions, and then there are India imperatives to that global acquisition, and you need to then follow it up in India. So when Wyeth got acquired globally by Pfizer, they've now consolidated Bayer and Pfizer into India. So that's the implication from a global perspective, and therefore a thing in India or a ramification in India that one needs to look at. What are the different types of M&A in India if one were to look at it? So one can classify them into the consolidation or hive-off phase. One which looks at mergers, demergers or joint ventures is where I would put them into this basket. So as I said some time back, the Mahindra Satyam merger into Tech Mahindra, or a Sterlite Industries merger into Shesha to create one entity on metal and mining, or the Reliance Petroleum merger into Reliance Industries could be one category of mergers that one can look at. Or there could be acquisition driven. And there are two forms of acquisition again. You look at a share purchase or through a primary infusion, and generally PE deals get done in this manner because private equity players are wanting to do their deals in a manner that will allow them to be part of the growth story of the target company, and therefore they would like the money to be used by the target company rather than secondary deals. But there will also be a full buyout, and this happens quite often, and therefore you buy the shares. Or you could do a business or an asset purchase. When does that come into play? When you are looking at buying a part of the business of the company and not the whole of the business of the company. So if I were to look at basically when the investment banking and the equity business of INAM got in a sense demerged or hived up into Axis Bank, that was a part acquisition in a sense, because not the full business was acquired but only the part was acquired, and each one will have its own nuances. So I always have said that if there is a deal in India, one needs to look at them very carefully, because I have is my own saying that every M&A action has tax and regulatory reactions. And what are type of tax that gets covered? Basically, it's income tax, which my distinguished colleague C.A. Drishti will take separately on all the implications. Stamp duty, company law, exchange control, indirect tax, accounting implications, Competition Act, SEBI and related regulations if you are a listed entity, or any specific industry related laws. So it's a gamut of all of these laws which are very important for us to look at. So what are the key drivers, as I said, for mergers or amalgamations? So one is acquisition, and you look at the Mahindra Bank and ING Vaishya Bank recent merger announced, or the Ranbaxy and the Sun Pharmaceutical merger, which is also an acquisition, and each one is structured in a manner the way they want to look at it, so that it becomes easier for them to structure it in a manner which is either tax efficient or from a business perspective very, very appropriate. So one has to look at this. Or it could be consolidation of operations to exploit synergies basically. So Tech Mahindra and Mahindra Satyam merger, or Pfizer and Wyeth merger, if one were to look at it, they are primarily to exploit the synergies of the same. Or you want to focus on brand image or stronger market standing through a single flagship company, and then you will try and merge all your entities and assets into one company, which is what I think the Serco group did recently, when they created Serco Global Services. Or if you look at what the UB group, the United Breweries, the brewery part of the business, did when it merged all its entities which were running the same business into one single entity, which allows them to look at it. Or Mahindra for the Systech business, when they folded up everything into one as part of their entire deal with CIE. I think these are examples which where people want to consolidate or focus or create a, or it could be for takeover of sick companies that one may look at it. And there are several such examples that one can look at it. For example, Arinbundo's buying of the Actavis loss-making European business was a sort of a sick business, and there were several such sick business in the European zone which were available at some point of time, or maybe even available now. I think in between the Indian economic sentiments or business sentiments were not good enough, but I think it will now pick up again. This needs to be watched out, a space which needs to be watched out. Basically, that's very important. Or there could be consolidation of promoter holdings, or access to common funds, and therefore you want to eliminate the number of companies in the group, or create sort of a listing, and that's different aspects that come into play when you look at mergers and acquisitions. Similarly, for demergers, I think unlocking shareholder and business value is very, very paramount in when it looks at demerger. So if you look at Polaris Financial Technologies demerging, the Intellect Design Arena Limited, the business, and therefore you will create different verticals, and each company focusing on what it needs to do appropriately. Or you want to acquire a part of the business, as I mentioned earlier, then you did what Pantaloons did with the retail business by folding it into the Aditya Birla Group company. So that's very important. So each one has its own appropriate strategy to be adopted, and you will adopt a strategy that comes into play. Companies Act is very important when you look at mergers, demergers in India, and from an overall perspective today, the way the process is that it needs to go through several rounds of approval. So the first is the board approval, then you will go to the shareholders approval. If you are not listed, you will go to the High Court for approval, and then as part of the High Court approval, you need to take clearances from the registrar of companies, the regional director, and if you are merging, also from the official liquidator. And that's a well laid out process that is followed. And obviously one has to watch out because the Companies Act 2013 has been enacted, and there are certain changes to the process in respect of mergers, and one needs to be clearly observing them. So for example, the key aspects of the changes there are that an auditor's certificate is now required for all schemes of mergers or demergers, whether you are listed or unlisted. Today it is only for listed companies, but it will going forward be required for everybody. A valuation report needs to be sent to all the shareholders and creditors to whomever notice is sent for the mergers. Today it is on a basis of if somebody asks for it, you will give it, otherwise you don't give it. The objections to the scheme today can be raised by any individual shareholder or any individual creditor who is impacted or affected by the scheme. But going forward, it has to be persons who hold 10% or more shareholding, or a creditor who has a debt outstanding of 5% or more of the total debts. I think this is to do away, in a sense, with some queries which may have come from shareholders where they don't hold too much. Then they are free to go and sell their shares if they don't believe that they want to go by what the overall shareholder community of that company has taken a decision on. So that's very important, from an overall perspective. Intimation to tax office, RBI and CCI has been provided for in the Companies Act. Some of it is already being followed even in the current act. What is opened up under the new Companies Act is, if as and when it will come into play, is going to be the cross-border mergers. Today, cross-border mergers are allowed, but it's a one-way street. Basically, you only allow inbound mergers, so foreign companies can merge into India depending on the law in that jurisdiction. Going forward, you can do both. Basically, you can merge an Indian company into a foreign company. Is it practically going to happen? Yes, it can happen, provided there are changes to other laws also. So the tax law needs to change to provide for tax neutrality of that treatment. The FEMA rules need to be realigned to be allowing such a thing to happen. And there is also one more good provision which allows not to go through a lengthy process like today of the High Court approval if you meet certain criteria. So for example, if you are a very small company, you can go through what is called a contractual merger, as I would like to put it, which is very, very simple to do and follow. Or you want to merge a wholly owned subsidiary into a holding company, you can follow that. So I think going forward, more and more transparency and easing of the process both have been incorporated in the new Companies Act. We need to see and wait as to when they will come into effect. As I explained, the process of merger and demerger is quite elaborately laid down. Basically, you go to the board, you go to your auditors to get an auditor certificate, and you do the valuation for swap ratio, and go to the board, audit committee and board to get it approved, which is then sent, to the shareholders to the SEBI and stock exchange in case of listed companies, or directly to the shareholders in case of other companies, or post SEBI approval in case of listed companies. And then based on the shareholders approval, you will again go and get the several approvals, as I mentioned, about relating to regional director, register of companies, or official liquidator. What are the key costs is always the question when you look at mergers and demergers. And I think that primarily, if you look at mergers or demergers, tax neutrality is generally provided for, both in direct tax and indirect tax, and the key cost, therefore, or the fiscal element that comes into play is on the stamp duty. And do we have a uniform stamp duty framework throughout India for mergers and demergers? The answer is no. And therefore, it is very important to plan this right. And I can assure you that no single individual will know the stamp duty law of several states which come into play. So if you have a company which is registered offices in 2 different states with assets in different states which are immovable, primarily, let's say for example, it is going to be a very complicated stamp duty calculation that one will have to do to determine what is the stamp duty payable on this merger. because there are set off provisions in certain states, the way they need to be worded, whether you actually get a set off on in practical terms, or you need to pay and then claim a refund. All this becomes very, very important, and it's a very, very essential part of the overall planning of the merger in terms of the cost that is involved, and then that becomes very, very important for companies to consider. Because if I look at the way it is divided, there are only very few states which have these provisions which are in a sense laid down. So you have Karnataka, you have Gujarat, you have Maharashtra, you have Rajasthan, you have West Bengal, and there are some few more states which are covering this completely. Andhra Pradesh, for example. But there are several states where it is being notified but not yet in place. So Tamil Nadu is one example, and several other states where it is not notified, but the local authorities. So in Delhi, they would want to charge on every court order. So I think one has to look at them very carefully. Moving on, I think there are other regulations also which are very important for us to consider, especially in a listing scenario. The approval of the stock exchange as well as SEBI is very important, and unless that is there, we will not be able to proceed ahead. And if the merger is between related parties, then it requires the approval of the non-promoter shareholders, and that is very important. It's a minority approval, but majority of the minority approval either through postal ballot and e-voting, depending on if you are related party mergers. And exchange control is liberal. Generally, you file a form post the merger, but one needs to be careful whether as a result of this merger or a demerger, you're not crossing the threshold limits laid down under the foreign direct investment guidelines, or you're not engaged in activities which are prohibited under the foreign direct investment policy, because otherwise you will need approvals. Then what are the other issues that one sees? One, obviously accounting is very important. The Indian accounting standard, which is AS 14, only deals with mergers and allows for two methods of accounting primarily, which is the pooling of interest method, where you do book value accounting, each asset taken at its book value in the merged entity, including the reserves that will be there, and then the difference is increase or decrease in the reserves. And you have a purchase method on the other end, where you can do as per the accounting standard fair value or book value accounting, and however the reserves lose their identity, and then the balancing figure is either a goodwill or a capital reserve. So that's a choice that now one will have to make, in what circumstances one will follow the pooling of interest and in what circumstances one will follow the purchase methods. So when I look at mergers, demergers, or corporate restructuring, I think it is important to put it into three baskets. Basically, what's the commercial rationale for that structure? Secondly, what is this existing structure, and what are the issues around it from a tax or regulatory perspective? And then define and design options or alternatives that one will want to have, so that it becomes easier to get into the implementation phase. So you lay down a blueprint and then go into the implementation phase. Moving on from mergers, demergers, or that mode of acquisition to a slightly simpler mode, because it doesn't involve a court process, so to that extent it is simpler, is buyout of existing shares from the shareholders, which you just buy out a company, which is what we call a secondary transfer, or putting in money into the target company. As I said some time back, private equity players like to do that much more, which is a preferential issue or a primary infusion of money. And third is business. Obviously, if you are interested in only one of the two businesses or one of the several businesses, you will want to do. And how does one consider what is most appropriate? And what are the factors that get into it? So if one were to just from experience perspective talk about it, I think it is whether you can get a step up in the cost base for assets, so that you can claim a higher depreciation from a tax perspective, because that's a tax saving and therefore cash flow saving. Or is there a possibility to push a debt down, because that becomes very important? Is that a possibility? Not a possibility. What happens to the existing tax holidays or incentives that the target company or the target business may be enjoying? Is it possible to carry them into, if you do, let's say, a share acquisition, or if you do a business acquisition, is it possible to carry them through in the new entity, or in the current entity itself with the new set of shareholders? Are they possible? So then, is the tax attributes, for example, minimum alternative tax credits or tax losses, are they transferable, not transferable? What are stamp duty costs? There's a different set of stamp duty costs for share acquisition versus a different set of costs when you do a business acquisition, because each state will have its own way of defining it. If it is shares, it is the Indian Stamp Duty Act which applies, and states do not have jurisdiction over it. But if it is assets, then the states will come into jurisdiction. What is the tax cost to the sellers when they sell? They will want to do their own calculation. So even if you are representing a buyer, I think it is very important in a deal to understand what will be the seller's imperatives, and then it helps you to structure the deal appropriately. Because if you don't keep the seller's imperatives in mind, then this deal will only be a discussion between advisors to a elongated extent, and that's not good from a deal perspective, because both sides will come under pressure to close at some point of time. What happens to regulatory approvals? So if I do business transfer, do I need regulatory approvals? Or if I do share transfer, do I need regulatory approvals? I think that's important. What happens to the historical tax issues or litigation in the target? If I were to acquire shares, then I'll be facing them. If I do a business, then there's a lesser extent that I face them. So one has to go through all of this aspects to determine whether one will want to do a share acquisition and one will want to do a business acquisition. And again, time frames. You may have only few days to close the deal, and therefore, disregard of everything else, you may have to follow a certain methodology. So obviously, a share acquisition will be much quicker, subject to that there are no approvals from a foreign direct investment perspective to be obtained. That may be a much simpler process compared to a business sale. So one will have to get into that field also. And again, within business or an asset transfer, there are two types of issues that one has seen. Do I want to structure it as a wholesale sale of business or a slump sale of business, as is known in direct tax, or do I want to structure it as an itemized asset sale? And each one has its own nuances in particular, because is there a VAT if you do a slump sale versus you do itemized sale? Slump sale does not have VAT. What happens to unutilized tax credits in an asset sale? And it's again a vexed question, because each state has its own VAT. Hopefully, with the GST coming in, maybe some of this becomes more uniform and simpler. And what happens to the transfer of liabilities or obligations, or stamp duty, as we discussed? Is it better in one versus other? And what is the nature of the gain or the loss in the hands of the seller entity? If they do a slump sale versus they do an itemized asset sale. So that's very important. On the other hand, if you're looking at a share acquisition, and that too of a listed entity, then one needs to be very careful, because the SEBI takeover code guidelines will come into play, and one needs to be clear whether it triggers an open offer. So today, SEBI takeover code guidelines provide that if you acquire 26% of a company or control of a company, you need to do an open offer, and open offer needs to be for 25%, and then you can't close your original deal till you have closed the open offer process. That's very important, because once you have got in, it's important to know this. So once you are above the 25% threshold, you're allowed a 5% creep up to 75%. And that's also equally important to know, because you may end up at 44% and then you want to just creep to 51 over a period of time. Or alternatively, do look at what Diageo did in the USL case or the United Spirits case. They went to 27 in the first place, or 28 in the first place, and then did another open offer for 26%, which allowed them to go beyond the 50%. But obviously the pricing between the two offers was quite different. That's important. So I think there are several factors that come into play, and one will have to go through it. Another important regulation is the Competition Act, and it's a one which is gaining more and more prominence. So you would have read in the papers recently, the first big case in terms of a local domestic acquisition was the Sun Pharma and Ranbaxy merger, which is before the Competition Commission now, and they are examining it in detail. But generally, what we've seen is they've been very pragmatic, and if you look at what the law is, that if you're acquiring an asset base of less than 250 crores or a turnover of less than 750 crore, and you satisfy neither of the above, you are either below either of the above, let's put it this way, then you don't need to go to the Competition Commission as of now. I think that is going to expire in the next 1.5 years or maybe 2 years, and then we will have to go to competition even if the size is this. Beyond that, they're looking at several thresholds in terms of what is the acquirer's base in India in terms of asset and turnover, or the group to which the acquirer belongs, and similarly what is the target this thing as a combined group, and that's very important, and I think lots of companies will fall in that bracket, whether within India or whether it is outside India. So it's very important to keep that in mind. But when you look at even acquisition, what is it that is the process that you would like to follow? So generally what we've seen is a term sheet being there, and then a lot of diligence happens, in terms of financial, tax, legal, IT, HR, and then you structure the acquisition, as I said, either as a share sale or as a asset sale after doing your analysis, and then a lot of time goes in the deal documentation. So relating to what are the tax warranties as far as we are concerned, what are the tax representations that the seller or the target company is willing to give, what are the indemnities needed, what is the transfer that will take place, who is going to be the transferor, is there a withholding tax obligation, not. Those are the critical decisions, and obviously if it is a listed company, then open offer comes into play, so your transaction gets pushed in terms of the closure. So I think that's what is very important from an overall perspective. I thought that I should give you this quick background on how M&As work and an overview with all the regulations other than the direct tax. As I said, this is just part 1 of the program. I think part 2 and part 3 will cover on the valuation and the tax implications of M&A, and they're going to be communicated or presented to you by my distinguished CA colleagues Sujal Shah and Drishti Mehta respectively, and we all look forward to this program, and hopefully I think we are able to provide insights to you that you can look forward to on this program. Thank you very much.